Mutual fund managers can charge anywhere between 0.03% to 5% of your assets to manage your assets each year. That doesn't sound too big, right? Wrong. A mutual fund manager charging 3% of annual fees can eat up anywhere between 40 and 50% of your total assets if you stay invested for 30 years. That could amount to hundreds of thousands of dollars. That's huge. Wouldn't it be awesome if you could keep most of the money? Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder, and I have helped dozens of women take control of their financial futures. Subscribe to my YouTube channel and follow my Facebook page to learn how to build your own wealth through investing. In this video, I will tell you how seemingly low mutual fund fees can destroy your investment performance. Let me demonstrate this with an example of a hypothetical mutual fund that returns 7% annually. Note, it's impossible to determine what a fund will return in the future based on its historical performance. Also, in efficient markets, fund returns tend to revert to their mean. To learn about efficient and inefficient markets, watch this video. Coming back to this hypothetical mutual fund that returns 7% annually, let's assume that you invest $6,000 each year starting today for the next 30 years in this mutual fund. If this fund charged an expense ratio of 1%, which is the average fee charged by mutual fund managers in 2020, according to Morningstar, you would have paid a total of $61,000 in fees over the lifetime of your investment, that is 30 years. And in those 30 years, your investment would have grown close to $489,000, which is almost $500,000. One would be very happy paying that 1% fee to get close to $500,000. However, what if I told you that the $61,000 that you paid in fees cost you $118,000 in your investment portfolio? Would that shock you? The $61,000 in fees is the explicit cost charged by the mutual fund. The remaining $57,000 is the implicit cost or the opportunity cost. I will explain what that means in a minute, but an easier way to think about this is that the 1% in fees that you pay to the mutual fund manager costs you a total of 19% of your total asset value. You don't have to believe me. You can do the math yourself. And to help you, I have linked my mutual fund fee calculator in the description below. Instead of 1%, if your mutual fund manager charged you 2% annually, that would cost you 33% in net asset value at the end of your investment horizon. And if we raise that 2% to 3%, your mutual fund expenses would have cost you 44% of your potential asset value at the end of your investment horizon. Don't even get me started on funds that charge 4 or 5% in fees. I have seen those. Those are definitely not worth your time or money unless they return above average returns consistently. Now, instead of investing in an active mutual fund, had you invested in a passive or an indexed fund charging 0.03% or 3 basis points annually, you would have only given up 1% of your total potential asset value in implicit and explicit costs. Before I discuss implicit costs of a mutual fund, let me talk to you about the explicit costs that are charged by the mutual fund. Explicit costs are listed in your mutual fund prospectus, so make sure you read it thoroughly before making your investment. Here's an example of fees from a real mutual fund prospectus. As you can see, there are different share classes, each with its own set of fees and conditions. The minimum investment requirements for each share class may also be different. Let's look at share class A. The management fee is 0.47%. The distribution fee is 0.25%. Those fees add up to an annual expense ratio of 0.72%. To invest in this mutual fund and have the manager invest on your behalf, you will have to pay 0.72% of the fund assets that are invested each year. You won't get a bill for fees. These fees get deducted out of your invested assets on a schedule set by the fund manager. Some managers deduct fees daily as a percentage of the invested assets. Management fee makes up a majority of the total annual fees charged by the mutual fund. These fees are charged by the managers to manage the fund and make investments for you. Distribution fees or 12B1 fees include marketing costs that the fund incurs to distribute and advertise this fund to other investors. So basically, current investors are billed this fee to attract potential investors. This fee benefits the fund and not the investor. Finally, other fees can include brokerage commissions, custodial fees, etc., and they make up a smaller percentage of the total fees charged by the mutual fund. Management fee, distribution fee, and other expenses make up the total annual expenses charged by the fund, and together they are called an expense ratio. In addition to the expense ratio, some funds also charge what are known as loads. If you like what you've heard so far, please smash the like button, and if you haven't already, please subscribe to my channel and click on the bell icon so you don't miss any of my latest videos. Also, if you're watching me on Facebook, don't forget to follow my page. I post a new video every week. And to help you better allocate your income, I've linked my personal budgeting worksheet in the description below, so don't forget to grab that. There are two main types of loads a mutual fund can charge. The first one is the front-end load or the sales charge. It is applied when you make an investment in the fund. So for example, if a mutual fund charges 5% front-end load, it's going to reduce your investment by 5% immediately. So for example, if you are planning to invest $1,000 in a mutual fund with a 5% front-end load, the fund will take away $50 and only invest $950 in the fund. So front-end load immediately reduces your investable money. The back-end load or the deferred sales charge is what a mutual fund charges when you withdraw out of the fund. For example, if a fund has a back-end load of 1%, if you plan to withdraw $10,000 out of the fund after 1 year of investment, the fund will only let you withdraw $9,900 and keep the other 1%. Typically, back-end loads tend to reduce over time, so a fund may start at a back-end load of 1% and then it will gradually go down to 0 over the next 5 or 10 years, whatever the schedule is. The back-end load is put in place by the fund to prevent investors from withdrawing early. So make sure when you invest in any fund, be sure to understand if there is a back-end load, because it's going to reduce the amount that you can withdraw at the end of your investment period. If you invest in mutual funds, look for funds that have no sales charge or deferred sales charge. These are called no-load funds. Now let me tell you about implicit costs or opportunity costs. You will not find these in the prospectus of the mutual fund, but these will reduce your potential investment return. This is the money that you would have earned through compounding had you invested all the money that you paid to the fund manager in fees and loads over time. For example, if you invest $1,000 with a fund that charges a 5% sales load, only $950 gets invested in the fund. The remaining $50 got taken away by the fund. If you had invested that $50 and the fund in the following year generated 10% return, that $50 would have grown to $55. So your investment could have made an additional $55 that it did not make. And in the following year, if again the fund made 10% return, your money could have grown to an additional $60.5 and so on. The longer you stay in the fund, the longer this money would have had the opportunity to compound. However, since you paid that amount in fees, you lost the compounding opportunity. As you can tell, increased fees and loads increase your opportunity or implicit costs. Take a moment to check your current investment portfolio, understand what kind of funds you've selected, what the fees are, then click on the mutual fund fee calculator below and determine how much you pay in explicit and implicit costs. Let me know in the comments what you find out. Be wary when someone says a mutual fund charges only 1%, because the seemingly low 1% can result in a significant loss in potential asset value. If you invest in low-cost index funds, your opportunity cost and your explicit cost will be lower compared to a high-fee mutual fund manager. Vanguard, Fidelity, and Schwab all offer cheaper index fund options that charge a few basis points in fees. For those of you who are unfamiliar with what a basis point means, 1 basis point is 1/100th of a percent or 0.01%. In my next video, I will talk about the time I met Warren Buffett and what I learned from him. Please subscribe to my channel so you don't miss it. That's it from me this week. As always, don't forget to be kind, to be happy, and to be your best self. Bye! And here are some more videos I think you will enjoy. I would really appreciate your hitting the like button and sharing this video with your friends and family. It will help me reach more people.